So I just want to touch on what we class as liquidity being valid. Now, what I mean by liquidity is when we get this sharp move up, the liquidity is created by this sharp retracement that we get. Now, the reason it's called liquidity is because there's built up orders there. There's people getting in at these points and with their stop losses below here. That's what liquidity is. So now in order for the liquidity to be valid, we want a minimum of a two candle retracement. Now, why? Because we want enough of a low where normal traders who are getting in at that point aren't going to stick their stop losses below here. They're going to put it below the low. And that's going to create liquidity to be taken out for us to get when it returns to the zone. Now, that's the reason we want two candle liquidity, is just so there's enough of a low. Now, second to that is we always want the high that created liquidity to be broken again before that move down to the zone. So once we get this move up, we get this retracement down, and the key thing here is that this high is now broken. So once it comes up to here, that's valid. So, and that just tells us that normal retail traders are getting in at this point. They see this point as a key area of interest.